Amagi Media Labs near 1800 crore rupee IPO that opens for subscription today. The price band of 343 to 361 rupees per share. For all those who are wondering, what exactly does Amagi do? You know, it sits at the backbone of an ecosystem where content owners schedule shows, insert ads in real time, manage inventory, and make money across all the platforms so that broadcasters don't have to rely on their infrastructure. So what was basically the infrastructure expense of a broadcaster is now being consolidated on the cloud by Amagi Media Labs. It's a bet on the way entertainment would be consumed on television going forward, but the question is whether entertainment would be consumed on television going forward or not. We do have Baskar Subramanian, who's the co-founder and managing director, as well as the CEO of Amagi Media Labs, joining us now. Welcome to the markets is what we'd say, along with welcoming you to the show. Baskar, the question is that in a business like yours, where a lot of the investment has been front-loaded, cloud infrastructure in particularly isn't very cheap. But you've obviously broken even last year. That typically happens when companies go for an IPO. The 1 year before that, numbers suddenly start to look wonderful. Wanted to understand, now that most of the mission-critical expenditure has been done, investments have been done for you, going forward, what's a sustainable revenue growth rate, and will profit growth outpace the revenue growth rate?
Yeah, thank you very much for giving us an opportunity here. As you rightly pointed out, Amagi is the media technology software company, primarily changing the way how TV networks worldwide take their content, operate on it, distribute it, and monetize it worldwide. So we largely work with people who want to create their streaming OTT solutions, taking content owners to a number of hundreds of distributors worldwide. That's the problem that we really solve today. Having said that, if you look at our last financials over the last couple of years, we've been growing at about 30% CAGR and demonstrating that the operating leverage of the business is starting to really run. If you look at our operating leverage across, we've kind of got our adjusted EBITDA from negative 21% to positive 8.5% over the last 2.5 years. Clearly, we're seeing the operating leverage work play out, not just on the verge of an IPO, but literally over the last 2.5 years that the company's been performing on that front. Why does it work is inherently because we are a SaaS business. The business has an inherent operating leverage built in. If you look at our net retention revenue run rate, if you look at it, is at 127%. This is equivalent to a same-store sales metric. That means our existing customers continue to spend. For every 100 rupees that they spent last year, they're spending 127 rupees with us. So it's a classic land and expand business, which has been growing for us. And if you look at our sales spend as well as our R&D expenses, as a percentage of revenue, they've continued to come down. Our cloud cost is continue to come down from a gross margin standpoint. So all indicators tell us that we are in a very, very good wicket of managing both growth and profitability going forward. And this is a continuing trend over the last 30 months that we've seen. And we would see this continuing going forward as well. That's the thought process here.
That your margins have seen an expansion from a negative 20% plus to about 8%. How much more is the headroom here? Because typically the margins expand much faster once that inflection point is achieved, the break-even point.
And you're seeing this. If you look at it, last year we ended with 2% margin. And just in the last 6 months, we've kind of been able to expand it by 6.5 percentage points over the last 6 months alone, for example. So we truly believe that this is a directional call that's happening. We are a vertical software companies. And if you look at vertical software companies worldwide, typical margins, 25% is not an unreasonable margin that these companies have been able to deliver at stable state. And that sort of is a directional call I think we could potentially look at as we kind of progress this forward over the next 2 to 3 years.
Baskar, streaming unification is the largest source of your revenue. In fact, 55% or more, followed by monetization and marketplace and cloud monetization. But does growth naturally taper then as the customer base continues to scale? And do you think this monetization and marketplace and cloud will then have to become your margin engine?
Not truly. If you look at it, see, we're at a very early phase of the market. If you look at it, both from a cloud transformation, less than 10% of the market has actually moved to the cloud worldwide. Second, if you look at streaming, streaming is the biggest growth lever across the country, across all of the media ecosystems worldwide. So in that sense, we're in a very early phase of the market. Almost 90% of the market has to transform over the next coming decade. We truly believe the possibilities and the opportunity is really in front of us, not really behind us to some extent. Right? We've only crossed less than 10%, which is actually moved to the cloud from a migration standpoint. Second, if you look at it, our customer base is about 10,000 plus. We are about 450 plus customers today as a company. I think there's a lot of leverage in front of us, both in expanding our current customers, where the 127% net retention is showing you, as well as the new customer base that we are starting to go global. So both are a big tailwinds for us as we move forward.
Baskar, let me get back to profitability because that'll be a key focus area for investors that are looking to put money in your company. There's been years of losses for Amagi, and it's only now that you've turned profitable. I guess the question is how sustainable that profitability is, because have you achieved this profitably purely because of cost controls ahead of this IPO, or what sort of trajectory do you see ahead here?
If you look at it, Ritu, and again, if you look at our RHP, for example, you would have seen this. This is not a one-off. There has not been any sort of reduction in cost structures that we've done as a company, artificially or otherwise, for the IPO. If you look at it over the last 2.5 years, and that's the reason you see the operating leverage playing out. 3 years back, we invested in R&D, we invested in sales and marketing to really build a global workforce, which is what's kind of playing out for us from an operating leverage standpoint. We do not see big investments other than the AI investments that we're already doing in R&D, and which is already expensed out in our books today. For example, we do not capitalize anything in our books. So we are what I see is really a secular trend going forward from a profitability standpoint. And that's because all the investments that we've made over the last 3 years is continuing to bear fruit. 2.5 years, we've demonstrated that, where we have almost 20% plus EBITDA percentage points movement towards a positive direction. We will continue to see that going forward as well. That's the confidence we have in our systems today.
Right. Bhaskar, in that light, two-part question. Part one, you mentioned investments made over the last 3 years. Are there more on the annual? One. And two, you have earmarked some of your IPO proceeds for inorganic acquisitions. Can you throw some light on A, competition, and B, what are the sort of companies that you are looking at acquiring from these IPO proceeds?
3 aspects. If you look at our business, fundamentally, if you look at it, as I told you, investments have already been made, and we are in the mode of literally primarily harvesting the investments going forward. And Amagi has built a platform called Amagi Now, which becomes the core infrastructure on top of what we built today. So that's an investment that's been completed. What we see going forward is really the AI investments, which are already been designed into our systems in terms of the operating leverage that you're seeing playing out. First, number one. Number two, from a competition standpoint, Amagi is a very unique position today across the globe as a only glass-to-glass media company, which is essentially starting from the camera till the point of a mobile phone or a TV screen where you're watching content on internet networks. Amagi provides an end-to-end capability that doesn't exist worldwide. And truly, because we've been fortunate to be the right place, right time, building this one software platform that the world really trusts on today. So we have an opportunity to really build it. Our competition is really hardware vendors, very legacy hardware vendors across the globe, who are obviously transforming themselves to become software players today. So there's no software at scale in that context of the world, right? From an M&A standpoint, just to give you context, we are seeing adjacencies which could be interesting for us to kind of look at acquisitions. We would continue to score for technology acquisitions, which you could tuck-ins, which you could actually acquire as part of the whole thing, as well as for customer buying. So any customers where contracts exist earlier, we could potentially be able to accelerate that. We would actually buy them. That sort of is the directional calls to be taking from an M&A standpoint.
Right, we take that point. Thank you so much for telling us about your company. You've whetted our appetite, but obviously more questions and more pointed questions coming at your direction in the next few days as you list, and thereafter you report your quarterly earnings, etc. as well. Wish you good luck for the IPO, and all the best going forward as well. But let's move on. Let's talk about the latest